So momentum is pretty easy to recognize on a chart, but there are a couple little things to understand and a couple little tricky things too, just to be aware of if you're using a momentum indicator. And you may think, well, when the momentum line is horizontal, you may think that momentum has stopped. You know, that it's basically stopped in its tracks. And that's actually not so. It's actually the acceleration has stopped, or it's starting to slow down, and it's going to accelerate or deaccelerate, or it's deaccelerating, and now it's going to accelerate maybe in a different direction possibly as it flattens out, it might go up or might go down. But it hasn't technically, you know, the price hasn't stopped or the momentum hasn't stopped. And that's the other thing, when you look at momentum, your eye will naturally line up with the price. It's okay with that. We did a little bit of that in previous lesson. But you know, and you think there's a strong correlation to that, you know, what you're seeing on the chart. And that can be true for sure. That's the whole idea of using momentum, but it's not always true, you know, as far as, you know, an exact lineup there as we learned there. So that's something just to be aware of when you're looking at momentum. A couple other things too is, momentum sometimes does mirror the price move, you know, because momentum is tracking the closing price X number of days back, a close number, certain number of days back. So we're looking at that. It will appear as a smooth line, a smooth price line. And the more days in your look back period, the smoother the line. We had used in another lesson the example of 10 days. If we had gone further back, like 20 days, that will actually smooth out the line. So if you have some real highs or lows, some outliers, that'll continue to smooth that out even further. But unlike the moving average, it does not include all the days in between. You know, by omitting that extra information, the line gets smoother. So what I mean is, if we're looking at 10 days back, we're looking at the price on that 10-day back. So if that was an outlier, you know, that would, you know, that would impact your momentum. But it's not looking at the prices that are happening in between like a moving average would. And that's what we're talking about. However, if you have a one-day price spike, you may see a jump in momentum for a moment, but later you will see a sudden drop as the data is excluded from the series. So you have that one-day price spike. Let's say it's a price spike up. You're going to see your momentum indicator have a, you know, maybe more of a change, maybe more of a dramatic change, and then it's going to, you know, account for that in the next day as it looks, you know, back at its look back period. So the spike situation is where it pays to look at price bars, right? We had a whole section around spikes and obviously looking at your open, high, low, close, or your candlestick price bars, and not just look at momentum, as that could be a little bit misleading. You know, so don't necessarily trade just on the momentum indicator. Again, different than momentum investing, but it's just trading on the momentum indicator. In fact, I think where momentum really does well is using momentum. Some use it as a primary indicator, but I think it works best as a secondary indicator. So you're using another indicator, you know, for maybe your price, or you're seeing something form, maybe a, you know, a doji or something like that. You're using a gap. We looked at a gap. You're using something else, and then maybe you'll use momentum to confirm that. So it's best to use it as another indicator. And if you're using it with another indicator, you can have your other indicator be the primary and then momentum be your secondary. Or you could also use momentum as your primary at that point, but you would use something else to kind of give you confirmation on it. It's really best with momentum to have some type of pairing and not use it just all on its own. Now, there are ways to adjust momentum or filter momentum too. If you shorten the momentum time frame, like we use an example 10 days, but if let's say shorten that to real short, like 3 days, you'll be more responsive to price changes. It's going to be the more recent prices, right? It's only a 3-day look back as opposed to a 10-day. Again, it's only looking at that specific day. That's what momentum is versus a moving average. But the idea is it'll be more sensitive to those price changes. And if you have a shorter time frame, it's going to show more buy and sell signals. You're going to have more whipsaws, or you're more frequently trading, and you might have some potential losses based on false trend signals, or maybe some more expense there depending on how you're placing your orders, because you're going to have more trading orders, and that if you reduce your time frame as far as momentum to have it be more responsive. Another thing you can do with momentum too is you can filter it with a trading rule, or apply a trading rule. So example, instead of buying or selling when the momentum line simply crosses the zero line, you could say you will take a buy or sell action only when the momentum line is crossed by more than 2%, right? So it's got to be at least 2% above that zero line or 2% below that zero line for a decision to be made. So now if you think about that, well, there's an opportunity cost by delaying for that 2% to be in place, and that's exactly true. That's what happens with filters. It helps strengthen your decisions, but it also costs you in terms of opportunity costs that you could have bought in. Let's say you could have bought in a little bit earlier and had a little bit more profit. by getting in earlier than waiting for that 2% to happen. But again, that'll help eliminate whipsaws. It'll help reduce whipsaws, help strengthen your buying decisions, especially if you're coupling it with another indicator saying, all right, I see this other indicator, this primary indicator out there. I'm going to follow my primary. I'm going to use momentum as my secondary to confirm, but I'm only going to use my momentum to confirm if it's, let's say, 2% above the zero line and my primary indicator is still showing a buy signal. Now I feel confident to maybe make a trade, maybe even a bigger trade at that point. So that's another way that you can kind of start putting this together. And later in the course, we talk about how to kind of do this and start pairing up different types of indicators. And momentum is great to pair up with other indicators as well. So with that, that's the building block of momentum, and you can just trade right on momentum, or you probably see it as ROC, or rate of change, and that's very, very effective. But there's a couple other ones that I want you to take a look at here that are in the momentum family that build on that, and so let's look at those in the next couple lessons here, and then you can kind of choose which one you like best.